Joining me now is FS Investments Chief Market Strategist Troy Gayeski. Troy, great to see you. Thank you so much for being here. How do you feel about markets here going into year-end and 25? Does this rally have legs?
Yeah, certainly in the short term, right, Maria? We still have more than 4% more money supply relative to nominal GDP compared to pre-pandemic. So there's plenty of liquidity out there, including over $7 trillion in money market funds. You know, the biggest issue for investors, though, even though we expect near-term strength, is that you're getting that growth in the S&P or the NASDAQ at either unreasonable prices or highly elevated ones. You know, the S&P is now 23.1 times next 12 months earnings. The Russell 2000 is 29.5. So what we find more and more is investors are looking for growth at a reasonable price, and what they're settling on is middle market private equity, where you've had about 5 to 6 times the revenue growth the last 12 months as you had in the Russell at much cheaper valuations. So we do expect continued strength. We do expect a good year for markets, just much less buoyant than we've seen, certainly since the election and in 2024.
Yeah, I mean, we've had real moves up on this anticipation that change in policy is coming. But I want to get your thoughts on business. Omnicom Group is in advanced talks to acquire Interpublic Group. The Wall Street Journal reports this in an exclusive this morning. The companies may very well announce this today. But this would create the world's largest advertising company, according to people familiar with the matter, says the Wall Street Journal. A transaction could be announced as early as today or this week, and the exact terms of this deal being discussed involve an all-stock deal is likely, valuing Interpublic at between $13 and $14 billion, excluding a debt. Some of the people said Interpublic had a market value of $11 billion on Friday, and this would have a net revenue of more than $20 billion based on 2023 figures. Renaissance Capital is also finding that there have been 140 IPOs priced so far this year, with total proceeds of up to nearly $29 billion, Troy. When you see this kind of a deal in advertising that may happen today and this kind of activity in the IPO market, are you expecting animal spirits to keep coming back this year and into 2025?
Oh, yeah, there's no doubt about it, Maria. I mean, for a whole host of reasons, most notably aggressive government intervention, you know, mergers really went on a long period, a long lull. And, you know, one of the things we've been waiting for in our liquid businesses is mergers to come back, you know, with a vengeance. So you're already seeing that deal activity announced. On the private credit side, we're starting to see a lot more financing opportunities come back to finance mergers. So that's really exciting if you're pursuing strategies to take advantage of that, like merger arbitrage, which we do in our liquid multi-strategy fund. So not only mergers, but also we do expect IPOs to come back as well. Not like 2021, however, and we would also caution investors that, you know, mega cap tech, regardless of your political views, will not be allowed to acquire anytime soon. But other industries like airlines, advertising, you know, food processing, et cetera, if it's a logical merger that doesn't have truly anti-competitive behavior, which, you know, in a globalized market where you have very thin margins in some industries is fairly hard, we do expect mergers to come back strong.
Yeah, I mean, part of the issue, Liz Peek, jump in here on this, is that Lena Khan over at the Federal Trade Commission was stopping all deals. That's going to change. So now you see more animal spirits activity with regard to deals, perhaps getting ready to come off the shelf in 2025.
Yeah, Lena Khan was a ridiculously heavy footprint in stifling merger and acquisition activity. Honestly, I've never seen a single individual impact markets more. But also, isn't it also the case that the private equity sponsors have got tremendous need to harvest some of their investments, and we've not seen that over the past year. So that, too, I think, is a tremendous source of M&A and M&A activity over the next year, don't you think?
What do you think?
Oh, I 100% agree, Liz. 100% agree with that statement. And to put it in perspective, you know, typically about 5% of mergers break any given year. You know, we were close to double that last year at certain periods. So 9% of mergers were breaking. And that was obviously due to very aggressive intervention, particularly in areas like airlines, which made, you know, very little policy sense. And then to your point on the private equity side, you know, large and mega cap private equity sponsors have really been struggling monetizing positions for their investors, which is one of the reasons their vintages have extended, which has created this tremendous secondary market for those that can provide liquidity. So there's both a pull and a push that should both drive mergers and IPOs next year.
Let's talk inflation. We've got a big week of data coming out. We'll get the November Consumer Price Index out on Wednesday. That's typically the market mover. And then, of course, it's followed by the Producer Price Index on Thursday, Troy. What are your expectations in terms of inflation and the impact on the Fed?
Yeah, so this is sort of the flip side of consumer confidence coming back and more optimism in the economy, is it's going to be a little bit harder for the Fed to continue to constrain inflation. We've gotten much more comfortable with a 2.5% to 3% annualized range, which we do think is appropriate. The last thing we need is the Fed to drive the economy into recession to get inflation below 2%. That's sort of creating a problem that you don't need. So, 0.2%, 0.3% makes sense to us. In the short term, inflation has bottomed. It'll probably run on the high 2 side into next year. That being said, we do expect the Fed to move ahead with a cut because it's fairly clear that the labor market has weakened substantially from a year ago. And until it really reaccelerates, we've seen certain signs of it reaccelerating. We think the Fed's bias is to cut one more time this year and then see where the data shakes out in Q1 before potentially cutting again.
All right, Troy, we'll leave it there. Great to catch up. Thanks so much.
Yeah, happy holidays, Maria.
And to you, Troy Gayeski.